Good morning. Welcome to another episode of Direct Talks. Today we have a very special guest. We have a market veteran, Mr. Prasanna Balachander. Sir needs no introduction in the institutional circles, but for individual investors, I'll still introduce. He is the head of global markets and the proprietary trading group for ICICI Bank. He has been with the bank for over 2 decades. Prasanna, he is a rank holder CA and a CWA. Subsequently, he also completed his CFA. And in the bank, like I have seen few talks, so there are some references of how like he has been a star on the trading floor throughout his journey. And personally, I am very excited about this discussion because of the broad, I would say, gambit of topics we are about to cover. So the way we are structuring this discussion is in three parts. First, we'll be discussing on the macro setup, like global macro and the Indian macro, so that we get the context setting. So from that, we come to the discussion on asset classes because the way a lot of debate is happening on equity versus fixed income versus, say, precious metals. So we'll be covering that, and then we'll be covering down to the sector specific discussions. So without further ado, I hand it over to Sir. Sir, the first question is, let's start with the global markets. Now, 2022 was a year which a lot of focus was on the policy measures of the global central banks, mainly Fed. So we saw 425 bips of rate hikes, which is the highest ever in a single year. And now, with that context, talks of inflation and now even talks of recession because of these measures. What is your view? Where is the world economy in the cycle, and how do you see it playing out this year?
So before I start, thank you, Abhishek, for a lot of nice things that you said about me. I just hope that all the things were true, or I'll maybe have to make it true going forward. I think your first question was with respect to what's happening in the US and whether the global growth cycle has kind of peaked out, there's going to be a recession, etc., etc. So I think our view remains that there will be a slowdown in the global economy as well as the US economy primarily. But we do believe that it will be a soft landing kind of a scenario. You rightly pointed out about the huge amount of rate hikes that has happened in the US economy and most of the global economies last year. And the lagged effect of all these monetary tightening along with the real income shock what will work as the primary channel through which the economy will slow this year. And we typically have seen that the monetary policy lag happens with a 4 to 6 quarter lag. So by that logic, all the hikes of the last year should actually end up affecting the growth of the economy sometime this year. And a strong labor market and a low household debt service ratio will also ensure that a hard landing is avoided. So while we do expect growth slowdown and a soft landing, for the reasons I mentioned, I don't think we expect a hard landing. And by hard landing, I mean that we don't expect really a hardcore recession to happen. We expect the US economy to slow down from 1.8% in 2022 to something like a 0.4% growth in 2023. So that's as far as the growth aspect is concerned. As far as inflation is concerned, we expect the headline inflation, which has actually already fallen substantially from the 9% handle to around 6%. It will further fall by middle of this year to something in the region of 3.4 or 3.5%, and by the end of this year to 3% in the US. And this will be a result of fall in both core goods inflation and in the shelter price inflation. Where there would be a little bit of concern is the level to which services inflation is falling, and that is something that will be very closely watched upon. And what all of this means for interest rates in this year, while they did raise interest rates by a huge amount last year, I think we do expect the FOMC, which is a Fed central bank, the central bank of the US, to raise policy rates by 50 basis points to 75 basis points in multiples of 25 basis points. You would know that they started the hike with 100, then 75, then slowed down to 50. So they started with 75, then to 50, and now they're probably going to slow it down to 25 basis points. And maybe a 50 to 75 basis points more of rate hike will happen. The market is also now predicting that there will be rate cuts from the US in the second half of this calendar year. But our view is still not of rate cut in this calendar year. We do believe that the central bank might do 50 to 75 basis point of rate hike and then hold on to that rate for the rest of the calendar year before embarking on a rate cutting cycle at the beginning of the next calendar year. That is what our expectations on the global economy is.
Thank you, sir. That is very helpful. So, from the global markets, let's come closer home. Last year, the RBI Policy Committee made a very interesting statement that while US market is talking of a landing, whether it be hard or soft, we are thinking of a takeoff. So, what is your view on the Indian macro vis-a-vis the global macro, and how is RBI placed, say, this next couple of quarters?
So I think the words that you reproduced are from Michael Patra's press conference,
Yes.
if I remember right.
Yes.
And I think that is more to do with wordplay rather than anything serious. But the fact of the matter is that India is and will be the fastest growing large economy in the world in the financial year 23, the current financial year. And even in the next year, we could possibly be in the top 2 in terms of the growth rate of large economies. But having said that, what do we expect as far as growth is concerned? So we expect India to grow at a GDP growth rate of 7% in FY23, which will then slow down to something in the region of 5.5% to 6% in the next financial year. We are still officially, our view is for a 6 to 6.2% kind of a growth rate, but there is definitely a downside risk involved because of all the growth slowdown that we are talking about on the global side. And like I said, the lower growth is a direct result of the impact of the weak global economy, which is resulting in lower exports growth for India. Exports is nearly 20% of GDP. So any contraction in this 20% obviously will have a good impact on the overall growth rate. Already, if you have noticed, merchandise exports have seen a substantial slowdown in December. Y on Y for just of the month of December, it was 12% down. Services growth has also slowed down to just a growth rate of 5% Y on Y in December. At the same time, we have seen lower FDI flows, startup winter happening very much, that startups are not able to garner equity capital. There is deceleration in the pace of hiring in IT sector, and even we are seeing some amount of job losses, higher bench strength, and so on and so forth. However, even though all these things are slowing down the economy, the long-term factors of reform-led growth is definitely improving. Investment outlook in India continues to improve, and primarily real estate cycle, the government capex expenditure, private sector capital formation, all of these things are something that will accelerate as we go forward. Government schemes have been really helpful in terms of heralding this growth, because the PLI schemes should result in definitely much higher capacity creation as more and more companies set up factories on an incremental basis with respect to taking advantage of these PLI schemes. So that's on the growth side. As far as the macro is concerned, on the inflation side, the heartening thing is that India's inflation finally came down within the tolerance band of 2 to 6%. It came down to 5.72%. So the inflation was never as big a problem as it was in the developed markets. Our peak inflation was at 7.8 down to around about, but that has also now come down to below 6%, which is the upper band of the tolerance level. But of course, we do feel that a lot of this fall in inflation is driven by vegetable prices and food inflation in general. Core inflation still seems to be on the higher side, and which is one of the reasons why there is not yet a view that the RBI will start cutting rates, and RBI will still have to keep hiking at least maybe once more before they keep rates at a pause at a repo rate of around 6.5%. One important reason why the RBI cannot let its rate hike cycle reverse very quickly, other than, of course, inflation being the target inflation being at 4 and we being at 5.7, means there is still some distance to travel. Other than that is the fact that the difference between the Fed rate and the RBI rate is an all-time low. And that does not augur well for currency in general. So you need the difference to be attractive enough for the view on the INR to be quite positive. So from that perspective, I think RBI will hike once more in February, and will hopefully remain at that level for maybe 6 to 9 months more. And depending upon whether Fed hike peaks at 5%, then you might probably see, and when Fed starts cutting rates in the beginning of next calendar year, you could see RBI also, maybe doing 1 or 2 rate hikes in sometime in the next calendar year. But otherwise, what we believe is that RBI to hike rates once more and keep the rates with a hawkish kind of a narrative and keep it at 6.5% for some more time to come.
Got it. So lots to digest there. So next question is on the Indian macro variables. So there is the one metric that is closely watched is the price of the crude basket. Now we saw like a very crazy spike till the early part of last year, and from that we have seen a substantial, I would say, softening of the global crude basket. So in that context, how do you see the Indian variables? On one side, like you mentioned, there is a fiscal deficit, there is a current account deficit to control. So how would RBI and how do you see the Indian macro variables stacking up before important budget also next month?
Yeah, so I think what you need to realize is every fall of $5 in the price of oil per barrel decreases our CAD as a percentage of GDP by close to 20 basis points. So oil import reduces by close to around $12 billion, while oil exports will be down to the extent of $4 billion, which means net there is still a saving of around $8 billion for this $5 price fall. Now, crude oil for Indian basket for January has actually averaged in the region of 76 to 78 kind of price. And before the fall, actually, most of the market was assuming, analyst community was expecting oil to be priced at around $100 per barrel, and we're estimating CAD at 3.4%. But after the fall in oil prices and take into account not only the general fall, but also the fact that there are no cheap oil imports happening from Russia, now India's CAD should see a savings of approximately 40 basis points to around 3% of GDP in FY23. And in the next year in FY24, since this benefit of this price fall, if it stays for the whole year, you could see it fall by another 40 basis points to around 2.6%. And so this CAD savings will not only be driven by the lower bill, that oil import bill that I was talking about, but also, services exports, which seem to be doing quite good. So all in all, our current account deficit is expected to improve substantially to around 2.6% of GDP next year. So it is nowhere near the kind of concern that people had. But at the same time, it is nevertheless an absolute high number which India needs to fund by having inflows on the capital side on both the FDI and the FPI flows.
Got it. So we understand now the macro setup for India and US. A very big, I would say, discussion and debate is on the asset allocation. Now, how does one position? I was actually looking at one data point, sir, which is very interesting. Is the mutual fund allocation of a HNI versus an individual investor and normal retail category. The HNI basket is fairly diversified across equity and even fixed income baskets. But when you see the retail individual basket, it has a very high skew towards the equity asset class. Now, given that context, so how do you see equity as an asset class placed currently? Maybe you can speak of India, global, but should one be over focusing on equities or should one look to diversify their basket?
No. So first of all, I think your audience and your clients and customers should realize that fixed income as an asset class has become much more attractive this year as we speak, with returns in the region of 7.5% to 8% for really safe government bonds and fixed deposits from the banking system, which was not available maybe 1 year ago. And hence, between equity and fixed income, the dice has shifted a little bit towards fixed income. There's no doubt about it. However, sticking to equity markets first and maybe discussing about fixed income later on.
Yeah.
I think the story this year of equity market will be a story of two halves. The first half will be kind of dominated by all kinds of peaks, which is, peak inflation, peak growth rate, peak central bank rates, peak hawkishness from central bank policy, and so on and so forth. And the second half will be the starting of the climb down from this peak across all the various things that I spoke about. And the interesting thing is, of course, when does the market start discounting the second half of the fall down and peak? My guess is the market will not actually wait for the second half. They will start factoring the benign monetary policy, the fall in inflation and the fall in peak right somewhere during the end of the first half of this calendar year. Now, if you really look at the equity market outlook, there are multiple, at least there are a couple of drivers for outperformance. First is the dollar weakness. So just like Hawaii, there has been a peak in the Fed hike cycle, and dollar rates are not going to go up at the same pace at which it went up last year. You could assume, and coupled with the fact that interest rates are going to go up in the rest of the currencies like the GBP, UK, and all, it looks like this year is going to be a year of weak dollar, or at least stable dollar, definitely not of dollar strength. That's what one takes a view. And typically when that happens, when the dollar tends to be weak against the G4 currencies and the dollar index tends to be weak, emerging market asset classes driven by emerging market currency outlook becomes very positive. And people get a lot of inflow into EM equities, emerging market equities, out of which India is a part of. So that is one reason why you can have a outperformance view on the emerging market equities. And the second is, of course, the favorable growth prospects. So obviously, one is the liquidity, which is the dollar weakness and the money flowing in. The second is what's happening to the earnings potential. And I think in terms of the growth differential, which China expected to outgrow substantially, with the China opening up, India also expected to grow at least 6%, if not 6.5 or 7. Then and with the global economies like the US going to grow less than 2%, less than 1%, global economy itself going to grow less than 2%, it's quite possible that earnings outlook for Indian and emerging market index companies also might be much, much better than the earnings outlook for most of the global companies. So from that perspective also, I think there can be a potential for incremental outperformance for the domestic Indian equity markets.
Noted, sir. So if I may, like, any thoughts on large cap versus small cap allocation? Because the audience that we have, there's a lot of focus into small caps. So do you see any thoughts on that?
So I think I should admit that while when COVID broke out, we had a view that there will be a K-shaped recovery, and we took a view that large caps, mid caps might perform better while small caps will not perform, and so on and so forth, because of this K-shaped recovery where the large gets larger and the small gets wiped out. But then what we realized is that even in our banking business, what's happening is that looking at companies from a mid-cap, small cap, large cap perspective was a little misleading. And what we found that irrespective of whether you are a small company or a medium company, if you are a leader in your vertical business or vertical of business, then, even if the entire industry is a small industry, but you are a leader in it, then you, though, will be classified as a small cap, possibly, or even a mid cap. But since you are a leader, you will do well. So I think that is what we were understood in the last couple of years. Look at the relative sizing of the company in the industry and then take a call whether they are likely to be winners or losers in this entire K-shaped recovery. My guess is every vertical, business vertical, will have the top 5 companies doing well and the bottom 5 companies, maybe ceding market share to the top companies. So that's our only, outlook.
Thank you for that view, sir. So we come to now fixed income. So you have already mentioned that between the two, it's kind of tilted now towards fixed income given the kind of rate hikes and everything. So 2 questions for you on fixed income. One is general view on this category, on this space, and second, if you may, for an individual, which are the 3 avenues of parking money in fixed income securities that they can consider?
So if you're looking at, of course, even within fixed income, you have a lot of risk return metrics, so to speak. And if you want to go to really safe returns, then you have the best possible investment is your small savings schemes and government bonds, which are traded in the secondary market. Those will yield, the government bonds will yield somewhere between 7.25 to 7.5, depending upon the maturities you choose. And small savings also will earn somewhere between 7 and 7.5%, depending upon the maturity that you choose. So that is one level of thing. The second level is if you want to really get into safe fixed deposits then of companies, then you will probably get the AAA finance companies giving you returns in the region of 8%. And if you really want to go even lower risk return perspective, you could possibly get, corporate deposits in the region of 9% to 9.5%. Bear in mind that all of these are marginally taxed at your marginal tax rate. So that is one. And second is that the risk return metric that you choose, the level at which you want to assume risk is completely your call. And these are various opportunities that are available, and that hence you can, pick up the call from that level. But what is most important to notice is that one is that bank deposits themselves are starting to yield 7.5% to 8% right now. And second is, since this year is likely to see the peak in interest rates, we'll probably see RBI hiking once more and then maybe holding off further rate hikes. It's good to lock in into fixed income schemes for the next, say, 3 to 5 years, depending upon what your liquidity position is. And another interesting asset class that is available is these targeted maturity funds of debt schemes of mutual funds, which will, tie down your holding period. If it's, say, 4 years and you invest in a 4-year target maturity fund, which basically means they will also buy 4-year assets and break it. So the risk of a market price going down by that 4 years is very less for you, because you will get back your principal by the time your holding period matures. So I think that is another thing that you can, suggest, you can invest. But having said all that, I think the best way to look at it is, consult your investment advisor. At the end of the day, each person has his own goals in life, has his own liquidity. So there is no one size fits all. What I'm giving is a kind of a generic kind of a view. So each person will have to take his own call based on his own asset liability profile.
Thank you, sir. Really appreciate those inputs. Viewers, on these instruments, I would be putting out some notes and threads on the company handle and on my profile on Twitter. So we come to the next question, sir. Let's come to domestic markets and sectors. So do you have any preference of, say, sectors which look like safer sectors in the complete, I would say, paradigm of global macro variables?
So before getting into directly, sectors, one aspect is you are all well aware that there is a growth versus value investing, right? So I think the slower growth rate and the higher interest rate, which is happening now, will actually challenge the valuation multiples of what we call as growth stocks, where the price earning multiple is at a very, very high level. And even the long duration stock, the new age stocks, are challenged because of this. And these stocks have, kind of witnessed many multiple levels of multiple expansion over the last couple of years. And that is primarily because of the fact that the opportunity cost of interest rates, or the money which is used to buy these stocks, is almost nil. And you are having zero interest rates in the global scenario. And hence the risk premium for these stocks were also at a historic low level. But this is now expected to change, resulting in kind of a derating of the growth stocks. So in this environment, overall, we like the philosophy of value because that basically means that the company is trading at a discount to what is the underlying value that you can, foresee. And you don't depend so much on valuation multiple, but you depend more on earnings growth and the fact that the valuation catches up with fair value. So I think in this scheme of growth versus value, financials and PSUs, kind of fit the bill. So that's on the growth versus value, which is a type of investing model. But if you have to look at that kind of themes which will work in the next 1 or 2 years, one is the first theme which I can think of on the domestic side is the financialization of savings. The positive aspect of the Indian equity market is, of course, India's demographic profile. A lot of us would have heard about India's demography doing wonders for the demand scenario for consumer goods, demand scenario for a lot of companies. But what was least discussed before COVID was what it does to the financialization of savings. And we all wanted the entire investing community in India to invest more and more into equity markets, let's say, or invest more and more into the banking system and all that. Whereas there was a heavy level of investment in real sector earlier. Now this, you also know that we have a very young working population. Or not only is probably we have become the most populous country in the world, we also have the highest level of working population. So that means the working population will have a high propensity to invest in high risky assets, like equity. And hence that there will always be extra push towards equity markets. Mutual fund asset under management has also increased at a 16% to 17% kind of CAGR in the last 5 years versus the high single-digit growth in the deposit growth. So the monthly SIPs also, I mean, it's a very, very commonly followed theme right now. It's more than 13,000 crores and expected to keep on, continuing with some minor adjustments here and there. And add to this the fact that EPFO and NPS are also, investing money into the equity market. So we prefer actually investors to increase their equity exposure and through professional managers like mutual funds, insurance, and all that, and use financial distributors and wealth managers who can actually evaluate the various things. So that's one aspect, which is financialization of savings. Then you have the China plus one theme, which is basically the global manufacturers diversifying their supply chain. Clearly, you're seeing a lot being said about what is happening to iPhone exports and iPhone manufacturing. So all that is also adding up. Every global MNC is today looking at what is the kind of dependence they have on single country exposure in their supply chain, which technically means a high level of exposure to countries like China, and they are diversifying out of it into other emerging countries. And India is definitely taking definitely much benefit out of it. And then the third theme is the manufacturing sector, which is a long cycle capex sectors. Due to China plus one, the PLI and the government focus on infrastructure, we really feel that India is now ripe for another round of domestic capex cycle. This will help the manufacturing and capital good companies. Even the long cycle capex, industries like power is expected to revive over the next 2 years because of this improvement in the manufacturing and all that. So all in all, it looks like all these themes are going to do well. And add to that the fact that real estate as a theme is also substantially improved, and the entire ecosystem around real estate is likely to do well.
Noted, sir. So the next question is on the country level valuation itself. Like, one area of debate always has been that Indian markets trade at a significant premium to say emerging market basket and even to the global averages. So can you share, since you look at global markets, can you share some thoughts on this? One, why do we trade at a premium, and can that sustain to that level?
Yeah, so I think that's a right question. We are trading at a huge premium over, let's say, emerging markets. So to that extent, the valuation is expensive in India. And not only are we trading at a huge premium, we are trading at a much higher premium than our historical. Let's be very clear, India has always traded at a premium over the average emerging market multiple. And that's because India has always offered the potential of high growth because of the domestic driven economy, the diversity of companies that are available, the different sectors that are there, the wide variety of investments that are possible. So India, and the very high quality of government policies that we have, the high quality of financial infrastructure that we have, the regulators, the kind of regulators that we have in both central bank, RBI, as well as SEBI and IRDA, and all these regulators doing a great job, meant that the risk of accidents, regulator-driven accidents, was getting lesser and lesser, and accompanied by this huge earnings potential, meant that India always traded at a premium. And what has happened over the last 1 year is also the fact that earlier we had talked about the huge retail money financialization of savings, which is getting into equity markets as well. So that kind of absorbed all the FII exits that happened in the Indian markets. While all other countries from which FIIs exited, the market fell a lot more. But they didn't have the potential of the domestic economy, domestic investor segment to support it. Whereas in India, we had this domestic segment to support it. And that's the beauty post-COVID. One of the significant behavioral trend that has happened is the fact that more and more Indians are investing into Indian equity markets, and hence the impact that FII selling has on Indian equity markets is far, far lesser. So that's the reason why we are trading at a premium right now. So it's quite possible that this premium will continue for some more time. In terms of returns, it's quite possible that our next few months, our returns might not be as high as returns from any other emerging markets. Quite possible that this valuation premium might narrow down. But that is not to say that markets will have a negative return. It's quite possible that we'll have a small positive return, but might not be as much as what the other emerging markets perform. And by that, our valuation will narrow down.
Noted, sir. So what I understand is we have always traded at a premium for the inherent growth reasons. The premium currently is higher than the averages, so we might see a reversion to that premium that we get. To that extent, we will still do well, but may not have a blockbuster year, is what you are saying.
Yeah, that's right. So I think basically we will do well to the extent of earnings growth. Normally, in a equity market, you have the earnings growth upside. Sometimes you have the P multiple upside. What we saw between 2020 to 2022 was also a PE multiple upside, where our markets were getting re-rated because of the kind of money which was flowing in. And that's why it was overvalued. Now, this year, I would say multiple re-rating might not be the case. But since one more year passes and our earnings rollover will happen into the next year, the earnings potential of the Nifty companies, of the BSE 200 companies, Nifty 200 or the BSE 500, the earnings EPS itself will grow. And hence our market multiple, even at the same multiple, there will be an increase in the value of the index to the extent of the earnings.
Got it, sir. See, you mentioned about the flows. So now there has been a significant change in the nature of participation in Indian markets. Now, FIs have been sellers in the last many months. In fact, I was looking at numbers even in January. The net selling has been close to $2 billion, 13 to 14,000 crores. But the inflow from the retail investors into domestic institutions, that has been very strong. But now there is also sign of some fatigue there, like not really tapering off, but some fatigue starting to kick in. And in the December number, we saw a pickup in the redemption numbers also on the SIPs. So do you see there's a risk building in with FI selling and the ability, my question is there more ability of retail investors to hold against FI outflows if that continues?
No, that's a great question and no clear answers. Nobody will be able to, tell you exactly. What we can tell you is, relatively speaking, from where we were 3 years ago to where we are today, the strength of the domestic institutional investor and the retail segment is far higher and better positioned to witness an outflow from the foreign portfolio investor, because now we are seeing inflows into EPFO schemes. EPFOs are investing into equities. We are seeing inflow into insurance companies. We are seeing inflows into NPS. And we are also seeing inflows into mutual funds in the SIPs through SIPs. And we are also seeing direct inflow from retail into equity markets. So it's a very difficult call. All I can say is that we are much better positioned relatively from an outlier perspective. Whether we will be able to perform much better last year than this year, I don't think so. But from a relative perspective, I think our retail investing community will hold our markets in good state. So if the rest of the market were to fall more, we'll fall less. But also, having said that, if the rest of the market starts going up, we will also go up, but we'll go up less because of the reasons I mentioned earlier on the valuation premium catching.
Noted. So one buzzing topic now is we are at that point of the year when there is a union budget coming in. And this is a budget which is also the last budget before the elections. So, any thoughts on how significant a year budget will this be? So my question, I would frame it this way, that we had a great year of tax collection, both on direct taxes and indirect taxes. But there is also, government has to balance many things, including deficits. So how are you seeing? Will this be a budget that will push capex, or will that be one that will be plugging in any gap on the macro side, or will it be something that can be a populist budget? Any thoughts on that?
Yeah, so the worries that the government turns populist comes every time. But I think this government has, when you say populist, you actually mean lower capital expenditure and more handouts, no more revenue expenditure, right? And maybe tax cuts and less tax mobilizations. But if you really see the history of this government, it has always been very, very fiscally responsible. Even during COVID, when we actually ended up having a much higher fiscal deficit, they didn't really go berserk. They did it to the extent it was necessary, I would say. And in the last 1 or 2 years, they have been putting money into capital expenditure, which has a very high multiplier effect in terms of the growth potential. So I think fears of government turning populist is very unlikely. I don't think they'll go that route. But I think buoyant taxes and collections driven by strong economy, better compliance, that will continue to provide room for the government to continue its kind of counter-cyclical stimulus through CapEx program. And with respect to subsidies also, we believe government may rein in the expenditure. Significant part of fiscal consolidation will be achieved through lower, subsidy bill, which is the right way to go about it. And then there might also be some rationalization with respect to personal income taxes. There might be some rationalization of capital gains tax. So all in all, somewhere I'm getting the feeling that they will do all the right noises in terms of whether it is subsidies or whether it is in terms of capital expenditure. I don't think they really go through the fiscal profligacy. And I think there will be some level of consolidation in the fiscal deficit to GDP ratio.
Noted, sir. So you mentioned something that is a lot of sweet words for investors, which is rationalization of capital gains possibility. So it's been a matter of debate with LTCG and STT both being there for the last 4 or 5 years. Do you think there's a case for, I would say, rationalization of cap? Why do you say that there's a case for rationalization, and how can one gain from it? Like, how should one position for it?
No, so first of all, I don't think positioning for these things are impossible. You don't know what the thinking is from the government side, so it's an event risk. And I think
I would rephrase my question. Should government rationalize capital gains?
So whether the government should rationalize, I think it's always a good one to think of rationalization. I think what's happening is there are different tax rates for different asset classes for capital gains and short-term and long-term. And there are different holding periods also. Whether it is listed bonds, it's 1 year holding period before it gets into long-term. If it is real estate, it becomes long-term after 3 years. If it's equities, it becomes long-term after 1 year. So there are multiple holding period, multiple tax rates. I think preparing income tax return on your own, frankly, when you have a lot of capital gains, is virtually, quite complicated. So I think from that perspective, any rationalization which leads to simplification of taxes, which equates various asset classes on the same platform as far as the holding period is concerned, and also which kind of, equates various asset from tax rates, is also not a bad idea. So I think if the government is looking at that, it is something that is very good. And I would then also say that it is not, I'm not saying that they're going to reduce tax rates on equities. In fact, for all you know, they might end up, rationalizing it, can be increasing somewhere, decreasing somewhere else. It's all quite possible. So it's impossible to position for any of this. But from a very, very longer term perspective, if it's going to make simplification of the tax calculation and simplification of the taxation regime, then I think it's something that is something to look forward to.
Thank you, sir. So last question. We have on the precious metals. Now, gold and silver had a good rally in the last 1 year. Now, how do you see it playing out from here? Do you see this rally continuing? Should one consciously make a portion of allocation to, say, gold and silver?
So I think gold prices can be quite volatile as well. Fell sharply Q1 to Q3 of 2022. And that was in response to the rising US yields along with a stronger US dollar. So you have to remember that gold is a good attractive hedge against inflation, is a good alternative to fiat currency like the US dollar. And you have to look at the opportunity in gold while measured against the opportunity cost of interest rates, because you're using your money to buy it. And if your money is going to earn, say, 4%, 5% interest, which is what your dollar return will earn, then that is the opportunity cost of holding gold. So it becomes less attractive to hold gold when your interest rates are going up because your opportunity cost is increasing. Now, what we are seeing in the last 10 days or 30 days is the fact that we are closer towards an interest rate peak. And that is the reason why when interest rate starts falling, then the attractiveness of gold improves because the opportunity cost is coming down. And that's the reason why we have seen, the gold rallying substantially. Physical gold demand has also revived over the last 1 month or so, over the last 6 months. because India and China together accounting for nearly 60% of the gold jewelry demand, and the robust outlook for both these economies actually ended up, especially after China reopening, means that the physical gold demand is also expected to pick up. Then central bank purchases has also been another source of structural demand for gold. EM central banks are purchasing gold and diversifying away from the US dollar. Because of the fact that when you print more dollar, then you risk depreciation, you are better off going into gold at that stage. So that has also happened. The share of US dollar in total FX reserves is gradually reducing, and the gold is improving. So I think overall net, there are positives and negatives at every point of time. But from a very asset diversification perspective, it always makes sense to hold gold to the extent of say 5 to 10% of your portfolio, depending upon what your propensity to hold is. There are schemes brought out by the government where you not only have the price impact of gold, but also get the ability to get 2% interest rate on that. So those are the gold monetization scheme and the sovereign gold bond scheme rather. I think those will be quite attractive for investors to look at. So overall, we are bullish on gold because of the interest rate cycle peaking out, but market has a capability to run far ahead of itself. So a lot of that view has already been baked in by the appreciation that we are seeing in the last 30 days. But nevertheless, I think you can expect the gold prices to remain stable.
Also, so we had a broad-based discussion on across asset classes, equity, fixed income, gold, Indian markets, global markets. So I had actually seen one interview of yours with Professor at SP Jain around 6-8 months back. So I figured out a very interesting side of you beyond market. But like, what is your area of interest outside market? You mentioned you eat, drink, and you sleep market. In the sense, you're looking at global markets, so it's round the clock. But when you're not looking at markets, what is your main area of interest outside the markets?
Means outside the markets you talk
Yes,
about.
one hobby outside the market.
No, I'm very passionate on movies and music. So I see a lot of movies, and that's my stress buster actually, because when you are in markets and when you are in economy and you keep processing information on a continuous basis, it's not as if you sat down, analyzed everything, made a view, and then for next 1 month, you don't need to revisit again. You have to keep revisiting it every minute, every day, and every month, and every week. So from that perspective, during weekends or during the evening time, I want to kind of, release my stress sometimes. And I think I'm a great fan of entertainment world. So movies is something that I like to see. And music, unwinding by hearing music is also something is a great pastime.
Got it, sir. So thank you so much for your time. It was a very fruitful discussion. I'm sure our viewers will find a lot of value. Personally, I would be going through the answers a second time because I could see a lot of things which you were saying one statement. They come from a lot of experience. So thank you for your time. It was a wonderful learning experience. And so we end it here.
Thank you. My pleasure, Abhishek. My pleasure.
Thank you, sir.
And one caveat or one advice to all the investors who will be listening to this is, at any point of time, anybody giving a view on the markets is a view given at that point of time. And no one, I repeat, no one has a 100% track record. Everybody works with probabilities. We all start with a 50-50 probability of going right or wrong. So I would advise and urge everybody to, consult their own financial advisors, look at their own risk return profile, risk return tolerance, and accordingly take investment decisions.
Perfect. Thank you for those words of wisdom, sir.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICIdirect.